I'm going to start by just talking about myself, who I am, why I should be allowed to actually have this conversation with you guys. And I'm going to try and keep it a little bit easy for you guys to have like a dialogue. So if questions come up, feel free to just drop in and ask those questions. I think that might be simpler than holding all your questions till the end, because each topic is going to be so kind of specific to that topic. So to start with, I have been in the mortgage business since 2005. I started before the 2008 crisis. My branch shut down at that time. I spent a little bit of time at home with my kids. When I got back in the business, I joined with Megastar back in 2012, and I haven't looked back since. And I love working for Megastar. I think it's a really great company. We are based in Colorado. Our corporate office is in Colorado. And one of the things I love to say is that it's owned and operated by a Hispanic female, as we're all females on this call right now. I love to just brag about that because I think it's just a really great thing that sets us apart. So I specialize in first-time home buyers, but I work with everybody. I think that if you can do something like first-time home buyer, somebody that's a move-up buyer that has a little bit more understanding of the process is simple. But I specialize in first-time home buyers and work really well with people that need a little bit more guidance through the process. I love this business. I love helping people. I love when you get to have that first conversation with somebody and they don't think that they can buy, and oh, it turns out, yep, you can buy, and here's how we're going to make that happen. And then all the way to the closing table, and people are just so excited when they get those keys and they get to own that first house or that 12th house, whatever that looks like. And it's just such an exciting, rewarding thing for this business. So I love it. I'm going to just briefly touch on Megastar's 4 promises. It's just something that Megastar tries to do. We promise to take complete and qualified loan applications, meaning that we're going to ask all the questions up front. We're going to make sure that if there's questions that somebody needs, if there's potential problems, that we're trying to get those dealt with upfront rather than having those come up at the end. So that's what that means when we take a complete and qualified loan application. We promise to keep in touch with our weekly reports. We send a weekly report to the listing agent, the buyer's agent, and the borrower on all purchase transactions. But in addition to that, we just keep in touch, make sure people are communicating. We promise to meet all real estate contract deadlines. I know that seems like a no-brainer, like, of course you promise to meet deadlines, but it is something that's very important to us, and it's actually, one of the core values at Megastar. So I pride myself on making sure that we meet those contract deadlines. And then prior to closing disclosure being a thing, we always promise to send closing figures to the title company 3 days prior to the closing date. So that closing disclosure wasn't as big of a burden for us as it might have been for some others, because that was just something that was already ingrained in our values. All right, so I'm going to start with some best practices with working with a lender. So what you should do, you should ask your lender to run payment numbers for a borrower, especially if figures are tight. So if you're working with a lender and the borrower, let's say the borrower says that they want their payment to be no more than $3,000, and you might be working with a borrower that's going to purchase a house and maybe the property taxes are high or qualifying might be a little bit tight. So whenever there's a situation when you need your lender to run figures, that is completely understandable. Ask them to run figures for a borrower as often as you need to make sure that those things are dealt with and that the borrower knows exactly what they're getting into before they get under contract. That's important. Ask your lender for a lender letter, obviously, but that's a do. Ask your lender about contract deadlines. This is something that I find to be pretty common, especially with new agents, is that you don't know what you don't know. And so sometimes you don't know that the lender might need a little bit more time on the appraisal. Like, for example, a VA appraisal has different expectations than a conventional appraisal. And so if you communicate with your lender upfront about contract deadlines, is this a realistic date? Then you don't have to go back to the listing agent and say and renegotiate those terms. To the extent that we can keep that as clean as possible in the beginning, then that means that you reserve all your negotiating tools for things that you really truly need to negotiate. So ask your lender about dates, make sure that they are realistic and appropriate. Ask your lender to call a listing agent when you make an offer. I'm really passionate about this. I think it's one of the ways that the listing agent really knows that the transaction is going to happen is when the lender calls a listing agent, has a conversation, make sure that they understand what it is that they need to know about me as a lender or any other lender, what they need to know about the buyer, any of those things. I think it's just a really great way for you as a buyer's agent to help the buyer get under contract. Ask your buyer lots of questions up front to get a sense of whether or not there may be a problem. So this is one of the things that I think really good agents do well, is they ask lots of questions up front, and then they kind of will help that lender understand that there may be a potential problem. I also think it helps you set your own expectations. If you know that, for example, somebody's had a foreclosure 2 years ago, then you know to set your expectations that this may not be something that we can necessarily do right now, but it's still, I think it's worthwhile for you to pass that person on to the lender, because one of the things I'll talk about is that sometimes those things are still, you can still work past those issues. So ask lots of questions, but still pass that information on to your lender. And it just gives you a sense of whether or not there may be a problem and helps you be a better communicator with your lender. And then ask your lender to partner with you on events. I know that the lender realtor relationship can be a little bit tumultuous sometimes, and it can be really frustrating for a real estate agent to feel like I'm always giving, and I'm not ever receiving. I will say, as a lender, it can be incredibly difficult for us to reciprocate on the same level that our real estate agents send us leads. So one of the things that most lenders that I know will do to kind of help with that relationship to make it feel a little bit more even is we are happy to partner with you on events. We are happy to attend events, attend open houses, help you financially if you're going to do something. Like, for example, Erica and I had done a Kona ice truck for our neighborhood. And that was something I was happy to partner with her on, because I know that that is a good way for us to give back as lenders. So what should you not do when you're working with a lender? The list for not doing is much shorter. You should not try to quote a mortgage payment, especially when mortgage insurance is involved. That can get you into some hot water. If your borrower, especially if your borrower is very particular about their mortgage payment, and you say, I think your mortgage payment is going to be about this, and I understand that most real estate agents that do that are usually pretty good about giving the caveats. I'm not your lender. Make sure you do this with your lender, but be careful when you do that, because mortgage insurance is so very specific to each specific buyer. It can vary depending on their credit score, depending on their debt to income ratios, depending on how much money they're putting down. There's so many factors that go into the mortgage insurance. You can really make a really good educated guess and be wholly off just because you just don't have all the information. So I just tell people, it's probably best if they have a question about the mortgage payment, just send them to the lender, make sure they're getting the information. It also helps them to encourage the buyer to reach out to the lender with those kinds of questions, and not necessarily use you as much to ask all those questions that you may not know the answers to. Don't assume a problem may be insurmountable. So, for example, that foreclosure where they maybe had a foreclosure 2 years ago, that doesn't mean that they can't necessarily do a loan. So I always excuse me, I always try to make sure that people understand that not every problem is insurmountable. And sometimes we try and get out of the box solutions. Sorry. Tickle in my throat. We try to get out of the box solutions to make sure that that there's sometimes that we might be able to get around something that may feel insurmountable. So I am going to pause there and open it up for any questions. Do you guys have any questions so far?
I just would like to make a comment. I love your organization. And I love that because I like to keep it simple, right?
Right.
So you're telling me exactly what your expectations are of me as the broker, and to clearly understand what I can expect of you. So thank you. I love this little cheat sheet list. I'll probably print it, and give to clients too, so that they, the buyers and the borrowers, so they understand. Right. This is who you ask for this, and this is who you ask, or you don't ask me about this.
Right.
So I think that is just fantastic. Thank you, Elizabeth. Very informative and very helpful.
Of course. And Dane, since you joined, if you have any questions, just feel free to pipe in, ask any questions that might come up, because it's a small group today. So just feel free to pipe in if you have any questions that come up, okay? All right. So I'm going to move forward now. So we in our business absolutely love acronyms. I'm sure you guys know this too. You guys love acronyms as well. But I'm going to go through a couple of the really common acronyms that come up all the time and make sure that you understand exactly what they are. So loan to value, or LTV. So the loan amount divided by the value. So for example, if the value is 500,000 and the borrower is getting a loan of 250,000, you would take 250 divided by 500, 50% loan to value. So so that's how you get the loan to value. And that is, if anybody ever refers to an LTV, sometimes we should have like swear jars for acronyms, because I swear sometimes we use acronyms because we're so used to them that we forget that not everybody knows exactly what we're talking about. So if anybody ever uses LTV, then at least you know exactly what that is and how to calculate it. This next one's a little bit more complicated, but I do think it's valuable for real estate agents to kind of understand what you're talking about when you're talking about these things. So DTI, if anybody's ever referring to DTI, it is the debt to income. So I refer to it as your total debt relative to your total income. So I've given an example here. So if somebody's getting a mortgage for $2,000 and they have $1,000 in additional debt, that means their total debt is $3,000. So when we compare it to their income, let's say there's two borrowers on the loan and one of them makes $4,000 a month and one of them makes $2,000 a month. So their total income is $6,000. So their total debt of $3,000 divided by their total income of $6,000 is a 50% debt to income. This can be helpful, again, asking lots of questions up front. This can be really helpful for you to kind of get a sense, is there something that might be challenging and we need to kind of have good conversations? Because if you do a little bit of quick math and you know that the borrower has $4,500 in debt but only makes $5,000 in income, okay, well, that might be challenging for us to figure out a way to get them a mortgage. Again, not necessarily insurmountable, but it does definitely require us to have more conversations, help them come up with some out of the box thinking, to help them figure out, how do we present you in the best light possible to get you into that house. So that's it for this page. Do you guys have any questions on debt to income or loan to value?
Where do you typically like to see borrowers in the DTI and the debt to income?
That is a great question, and we're going to go over it because each loan type is very specific.
Aha, thank you.
You're welcome.
A little foreshadowing.
Yeah. Dane's so quiet. Dane, do you have any questions about this so far?
I am just sopping up all your wisdom.
Okay.
I don't have any questions yet. Thank you.
Okay, sounds good. All right, I'll keep going. All right, so we're going to start with conventional loans. What I'm going to do is I'm going to break down each of the loan types that kind of come up and what exactly you need to know about each of these loan types. So I hope you guys don't mind my gifts. I have to throw a little bit of humor in here, or else this is like the driest of dry content. So hope those aren't too distracting for you. Okay, so on a conventional loan, what you need to know is that it requires at least 3% down, but in many cases may require up to 5% down. And that will depend on how much income the borrower makes and whether or not they are a first-time home buyer. So if you are within a low income category, then you can probably get away with just 3% down. If you are within a high income category, but you're a first-time home buyer, you can also get away with 3% down. Now, this doesn't take into consideration potential for down payment assistance, which I'll also talk about, but this is just like the basic. If you're getting into a traditional conventional loan, you need at least 3% down in most cases. The higher the credit score, the better for a conventional loan. It's your kind of top tier. Most people are striving for conventional. So if you've got a good credit score, that's good news. And that's going to make it easier for you to qualify on a conventional loan. General rule of thumb is a 45% debt to income. So I'm going to use easy math because it's going to be a lot easier for you guys to kind of remember this. So if total income in the household is $10,000, you're going to be looking for no more than $4,500 in total debt. That includes the mortgage, all credit cards, car payments, student loans, everything. And that's monthly debt. Okay, so general rule of thumb on a conventional loan, 45% debt to income. You can get it approved higher in some circumstances. Sometimes it's going to require it to be lower, but that's just a good rule of thumb. If you're about 45% debt to income, conventional may be a good fit. Condos require special approval, and this can be really good information from both the listing agent side as well as from the buyer's agent side. Condos in litigation can be problematic on a conventional loan. And when you're putting more down on a condo, it can be easier to approve. So if you're the listing agent, that can be good information for you to have, because you know that if you get 2 offers and they're both equal, but one is putting less money down and one is putting more money down, I can tell you that the condo approval process for the person that's putting more money down is probably going to be a little bit easier. There isn't going to be quite as much scrutiny on a conventional loan when you're putting more money down. So that's good for you to have from the listing agent side, but from the buyer's agent side, it just means that it's going to require special approval and just making sure that we get it through the process to make sure that all the T's are crossed and the I's are dotted when you're working on a condo. And then most people know this, but in case you don't, mortgage insurance is required if your loan to value is more than 80%. So if the borrower is putting less than 20% down on a conventional loan, mortgage insurance will be required. And mortgage insurance does go away with a conventional loan automatically after enough payments are made. So like the rule of thumb is about 78%, but it just depends on how much they started with, how much they put down, and how long it takes them to kind of get to that point. But generally speaking, after about 78% from the original value, that mortgage insurance is going to go away. And one thing for you guys to know, to just be a tool for your buyers, is mortgage insurance can sometimes be removed without refinancing by reaching out to the existing lender. So in this market in Colorado, where values are just going nuts, it's not like they're not going nuts everywhere, but they're definitely going nuts in Colorado. That's good information for you to have. Not all buyers have to do a refinance in order to get rid of mortgage insurance. Right now, refinances are so popular because interest rates are good. So not only removing the mortgage insurance, but reducing the interest rate can definitely make it more appealing for buyers to do a refinance in this market. But if interest rates go up, it's a good tool for you to know. You may not have to refinance in order to get rid of your mortgage insurance. All right. And then this next part is just general information, and I'm going to compare conventional to FHA and all the other loan types. That just kind of gives you, okay, if you know somebody has had a bankruptcy or they've had a foreclosure, this is just really good information for you to have. And I am happy to send this slide deck out to anybody that would want it, so that you can have all these little tips and tools to kind of in your tool belt, so that if somebody asks you a question, you're like, I know the answer to that question. So Chapter 13 bankruptcies are a little bit strange, and they're treated a little differently on a conventional loan. They are, if you're 2 years past the discharge date or 4 years past the dismissal date on a Chapter 13 bankruptcy, then you can do a conventional loan. And on a Chapter 7 bankruptcy, it's 4 years or 2 years with extenuating circumstances. I will tell you, I have tried and tried to get extenuating circumstances approved. mostly on FHA loans because they're easier, but it's really difficult to get extenuating circumstances approved. But again, doesn't necessarily mean it's insurmountable. I highly recommend people at least try. You don't know that you might not be able to get it, that you may be able to get it approved until we try and get it into underwriting. So I highly recommend if somebody's like in that 2 to 3 year range on a conventional and they want to try and get it approved, it's certainly worth a try. Conventionals take the hardest stance on foreclosures. They are a hard 7 years on foreclosures. Again, that 3 years with extenuating circumstances, but those are hard to get approved. So that's what you need to know about conventional. So pause. Any questions on conventional?
Nope.
Okay. All right. FHA. So we just did conventional. Now FHA is the second most common, I would say. And what you need to know on FHA. So FHA requires at least 3.5% down. They are more flexible on credit score and debt to income requirements. So in general, 620 or better on a credit score is best. So where a conventional, the higher the better. So if you're over 680 or 700 or 740, those are good credit scores on a conventional. You can get approved oftentimes at a 620 to 680. We probably are going to start looking at conventional. And then they'll actually take debt to income ratios higher than conventional. But generally speaking, if you're less than a 50% debt to income ratio, that's best. So again, easy math to make it easier. 10,000 total income in the household, you would want no more than $5,000 total monthly debt, including the mortgage payment. I will say we get approvals over 50%. Oftentimes, especially if you've got some other compensating factors, like you're putting more money down or you've got reserves, there are circumstances where we can get somebody approved over 50%, but just general rule of thumb is if you're below 50%, that's good. Condos must be approved by FHA. And again, I'm giving you this information to think about it from the listing agent side as well. So one of the things that I think is really helpful for listing agents to know is if you're going to, like, let's say you have somebody come to you and say, I really want to list my home, but I know I need to do some work, and it happens to be a condo. And you go and you investigate and you figure out that condo is not FHA approved. And you know that seller is going to need to take some time to get the house ready. So maybe they have some paint to do, they have whatever it is that they need to do to get that listing ready. I would say it's in your best interest as a listing agent, and it's in the seller's best interest as seller to figure out if there's a way for you to get that condo approved for FHA. Because if you can get that condo approved for FHA, it opens up your options dramatically. Now, it's not always possible, and some condos are never going to get approved for FHA, but if you as the listing agent can act as a value add for your seller to help them figure out a way to get that FHA approved, it can really, really open up your options, because most buyers that are buying condos are going to be FHA buyers. And if that condo is not FHA approved, it's a no-go. So if you had questions on that, like if you had a seller that was in that real situation, I'm happy to guide you through, okay, what can we do to figure out a way to get this condo FHA approved? Let's work with the condo association and figure that out. Now, that's different if it's a townhome. Townhomes do not need to be approved by FHA. And same thing with a conventional. If it's a townhome, it does not need to go through the approval process. And the best way that I find to look at whether it's a townhome or a condo is the legal description. The legal description on a condo will almost always tell you it's a condo, except in Jefferson County, which is a pain in the butt. All right. In addition to the condo has to be approved by FHA, there is also a new approval process on FHA condos that may make it more difficult to get it through the process. So from a buyer's agent perspective, keep that in mind when you're writing a contract for an FHA buyer that's buying a condo. Allowing for a little bit more time on that contract is probably going to be in your best interest. And mortgage insurance is required, and in most cases will stick around for the life of the loan on an FHA. Okay, so some people get scared away with this, especially buyers, but I will say it's not all bad. The FHA isn't the evil program that some people kind of think it is. In general, FHA mortgage rates are significantly lower than they are in conventional. And so if you compare a conventional loan where you've got kind of mid to low credit score and an FHA loan where you know that that mortgage insurance is going to stick around for the life of the loan, oftentimes it's still in the borrower's best interest to do an FHA loan because that payment may be significantly lower when all other factors are considered. And so FHA isn't an evil program. It's a really great program for the right buyers. And it's not necessarily a bad thing that the mortgage sticks around or the mortgage insurance sticks around because that rate is so low. Properties requiring an FHA appraisal will be more heavily scrutinized. And if you haven't had this situation as a listing agent or a buyer's agent, where you've had an FHA appraisal, where the appraiser required some items in the property to be fixed, it's definitely good information for you to know going into it. If you're the buyer's agent, you're watching for guardrails as you're walking through that property. If there's any kind of cracked windows, if there's any peeling paint anywhere on the shed that's not attached to the property. Peeling paint is definitely the biggest issue that we see on FHA appraisals. So if you notice peeling paint, both as a listing agent or as a buyer's agent, it's going to have to be remedied before that appraisal comes in. Ideally, sometimes you can get a final inspection, but if we can get that remedied before the appraiser ever goes out there, that's better in almost all circumstances. And then FHA appraisals are transferred from one lender to another, and they're good for 120 days. So this is pretty common. And if you're new to real estate, you won't have had this experience yet. But what will happen is if you as a listing agent have an FHA contract and you get an appraisal on that contract and the buyer falls out, let's say maybe they get denied and they can't go forward with the loan. So you have an appraisal now, and that appraisal will hang around with that property for any new FHA buyers. So in this current market where we're asking or where listings are going for so much more than the appraisals in some circumstances, that can be challenging because you have this FHA appraisal that's kind of sticking around from one FHA buyer to the next FHA buyer. So on the next listing, if you're able to accept a conventional offer, it may be in your best interest because you may not be stuck with that FHA appraisal that maybe is lower than what the list price is. But as the buyer's agent, you know that if somebody has fallen out of the contract on this transaction, maybe the buyer doesn't need to do an appraisal because there's already one that's with the property. So and then the other information is Chapter 13 bankruptcies are 2 years, Chapter 7 are 2 years, and foreclosures are 3 years. So again, they're much more flexible than conventional. And I have spewed way too much information. So I'm going to pause again and ask questions and ask 4 questions.
So I have a couple of questions and I love all the information. Thank you. So on the FHA appraisal, let's say buyer 1 falls out of contract and we're not really questioning the value amount. I've got buyer 2 that comes along. Does buyer 2 then buy that appraisal from buyer 1?
Yeah, so that's a really great question. And that's a very case-by-case specific situation. The lender is kind of the owner of that appraisal. And so what will happen is buyer 1, let's say they get denied, but they paid for that appraisal, buyer 2 may not have to pay for that appraisal because the lender's already they're zeroed out, they don't care. But if buyer 1 never paid for that appraisal, then buyer 2 will most likely have to pay for that appraisal before the lender will release that.
Okay, good.
Does that answer your question?
Yes, thank
Okay.
you.
What else? You said a couple questions.
Oh, so the condos, to approve a condo, doesn't that typically need to be the entire condo complex?
Yeah. Yeah,
So you would then go in and tackle handling that condo approval before you actually put it on the market as a listing agent?
if possible. Now, I'm gonna say not every situation is possible like that. I'm just saying in the hypothetical scenario where you know that the seller is gonna have to take some time to get some work done on the property, so you have some time in your corner, you will open up your options for buyers dramatically if you have an FHA approval on a condo. That's not possible in every situation. If you go to a condo and it's ready to list, then you're probably going to list it and just let everybody know that it needs to be a conventional or a cash offer. So, but in the circumstances where you do have time in your corner, because FHA doesn't, no, the bureaucracy, nothing is fast. So they'll take their jolly old time to get it approved, but it's in your seller's best interest and it's in the association's best interest to get that done, because eventually somebody's going to want to buy that as an FHA or sell that to an FHA buyer.
And how stringent are they on the homeowner occupied versus the investor owner?
That's a good
the
question.
ratios on that, and what
Yeah.
and what are those typically, or does it just vary
I don't know the
association
exact.
to association?
Yeah, I just know that if you have a high percentage of investors in a condo association, you're going to just be challenged on conventional and FHA. If you have a good even percentage of investors and primary residents, you're probably okay. But definitely that is the biggest factor, is if the condo's in litigation, or if there's a high percentage of investors, or really honestly, most of the reasons that most condos are non-FHA approved is just because of the bureaucracy of the situation. And they just don't want to have to provide all the documentation. And it's kind of a nightmare to go through the FHA approval process, but it's in homeowners' best interest to get that approved through FHA.
Okay, good to know.
Yeah.
Thank you.
Right.
Learn something new every day. I didn't know you could actually go in and start that process before you list a property. So if you do have investors or owners that know they're going to put it on, say in the spring, it might be good to start that now.
Exactly.
Okay.
Yeah.
Great.
Dane, do you have any questions?
And Nico, thank you for joining us. I see you just joined us.
Hello, Nico.
Good morning. Good morning.
All right, if no other questions, I'm going to keep going. All right, so we talked about FHA. So the next one is VA. And this one is another one that's pretty common. So obviously these are for our veterans. The nice thing about VA loans is that there is 0% required for down payment. That said, you can't get into the house with no money because closing costs will still be required. So I generally tell people when they're trying to get into a VA loan, you should expect to spend somewhere between $5,000 and $10,000. Generally speaking, you're about $7,000 on a VA loan, just depending on purchase price, what all your costs are, et cetera, et cetera. But that's just kind of a nice rule of thumb, is about $7,000 is about what a VA buyer is going to need. They must be eligible, and eligibility is determined based on their service to the military. So in general, if they have served for at least 4 years, if they have served during combat, if they are currently serving, or if you are a surviving spouse of a veteran, in general, you're eligible. But the way that the lender checks for eligibility is we actually take their social security number and we go to VA directly and we put their social security number in. And most of the time it comes back automatically and it says, yes, this person is eligible, or no, this person is not. Every once in a while, it requires just a little bit more due diligence and it takes a little bit more time. But that's just kind of to give you a sense of what that process looks like on our side. VA is one of the most flexible when it comes to credit score and debt to income requirements, which is kind of interesting. 620 credit score is best. And again, less than a 50% debt to income is best. I have seen them approved, I'm not even joking, at a 67% debt to income ratio. It just depends on the veteran. It depends on their circumstances. It depends on their other compensating factors. So there's a lot of flexibility on VA, but in general, if you're less than a 50%, your process is going to be a little bit simpler and it's going to be a little bit easier for you to get approved. So that's, and again, easy math, and especially for Nico's sake, since you just started. So if you have $10,000 in total income, then you're going to be looking for $5,000 in total monthly debt, including the mortgage payment. So that's how that debt to income ratio is calculated. Mortgage insurance. Oh, go
I
ahead.
was just gonna say, Elizabeth, I think Nico put in the chat that she heard that if you have at least a 1% disability rate, then you do not have to pay closing costs. Did you want to go over that, or Nico, did you want to chime in?
I think it's pretty clear, I guess, my question. So I've worked with a couple of people, and I had one lender tell me one time that if you have at least a 1% disability rating with the VA, that you don't have to pay closing costs either.
So that's not technically true, but what they're actually referring to is the funding fee. And it was like you were psychic and you knew what my next bullet point was going to be. So the funding fee is kind of like what VA does in lieu of the mortgage insurance, is they charge a funding fee, and that funding fee is based on the veteran's status. So if somebody is disabled and they don't necessarily, it doesn't, disability rating as far as like how much percentage of disability they are doesn't necessarily come into play. I've seen people that barely are disabled and they are exempt from the funding fee. That's one of the factors that will come back when we check eligibility, is it will come back and it'll tell us whether or not they're required to pay a funding fee. That funding fee is a big chunk of their closing costs. So I can see how that would get really confusing, because it doesn't necessarily mean they have no closing costs. It just means that their closing costs are significantly reduced because that funding fee doesn't exist if they're disabled. Does that answer your question?
It does. I mean, I'd still love to be able to see like a closing disclosure or something.
Yeah.
So that
Yeah.
I can determine like what kind of costs the buyer would still have to be responsible for, because I've not had to deal with those yet.
So you mean today, or you mean just like when the buyer is out there looking?
More for an educational purpose,
Okay.
just so
Okay.
that I can have eyes on sort of a draft version of a closing disclosure, just so that I can see what other costs they would be responsible for.
Yeah, so I didn't actually think about that in my presentation today. So Nico, if you want to, you and I could definitely connect offline, and I am happy to go through exactly what a buyer would expect on a closing disclosure on a VA loan. And if there's time, I might just open up a file and kind of just demonstrate what that might look like, if like a pretend file, if there's time at the end.
Okay, perfect. I actually have two potential loans that would be VA and with a disability.
Nice. Okay. So generally speaking, like usually I ask a borrower, were you discharged or have you suffered any disability as a result of your service? And if they say yes, I'm almost always going to assume that they're going to be exempt from the funding fee. But until we get that eligibility from VA, it's hard to know. And so that's just like, that's the surefire, is just to make sure that you get that eligibility. So, okay.
Thank you.
Yeah. Okay, so condos must be approved by VA. And so VA, like FHA, they go through the process to approve a condo association. And once they're approved by VA, then you are in, like, that's sweet sauce. And as long as the further approval isn't required like it is on FHA and conventional. So like, for example, I had a buyer that wanted to buy a condo that was in litigation. And they were a VA buyer. And I called the listing agent and I was like, hey, so you should probably know that this VA approval is probably going to be the easiest of all of them, because we're not going to necessarily worry that they're in the litigation, because it's not necessarily going to come up as part of our transaction. So as long as they're approved, as long as the association is approved by VA, then it's usually the easiest one to get through the process. So that's kind of helpful information. And then properties requiring a VA appraisal will be more heavily scrutinized like an FHA, but not quite as bad. Same thing, safety items, guardrails, cracked windows. They also don't like peeling paint. Those are the kinds of things that you're going to be looking for. And then VA appraisals can be transferred from one lender to another and are good for 6 months, like the FHA appraisals. The thing is, and why most people don't know this, is because it's really hard for you to go from one VA borrower to another VA borrower because there's such a small percentage of the buyers that are out there. So you don't usually see a lot of transferred VA appraisals because it has to go from a VA buyer to a VA buyer. And then lastly, just your information about Chapter 13s. As long as they finish making all payments satisfactorily, you can usually do a VA appraisal or a VA loan. And then for Chapter 7 or 11, it's a 2-year process, and they are the most lenient on a foreclosure. So if you're only 2 years out from a foreclosure, then you can do a VA loan. So I'm gonna pause, open it up for any questions. You guys are so quiet. No questions?
No, I think you have completely given us lots and lots of information. I'm just chiming in here so you can have a moment to breathe because I know how that goes.
Thank you.
Yes, but no, I love the information, and especially the information about that the VA is not concerned with litigation.
Yeah.
I'm also curious about what kinds of litigation do you typically see when people come across that? Because again, somebody that's new in the business might not know, what kind of litigious activity would happen within a condo association.
That's a good question. I would say the most common one that we see these days is there's something regarding the roof and the insurance. That seems to be like, if you're in litigation, that almost always seems to be the problem. But every once in a while, it might be something like maybe somebody fell and they sued the condo association, something like that. And it will depend on the type of litigation and who is the potential responsible party on the condo as to whether or not you can get them through the approval process. But it's definitely, if you're in litigation, it can definitely cause more drama, and it's just so nuanced to the situation. Okay, cool. Anything else? No? Okay, all right. So the next program I'm going to talk about is one that's much less common, but is a really, really great program for the right buyer, and that is USDA. You probably know USDA as the beef company, and that's pretty much what it is, the United States Department of Agriculture, but they also do mortgages. This is another program that requires 0% down. Closing costs will still be required on this one, much like a VA loan will. They are income restricted. So you have to not exceed a certain income in order for you to qualify for USDA. And they are very strict on credit score and debt to income requirements. So in general, if you are over 720, that is a good world for USDA, and a less than 43% debt to income. And in this case, it actually also considers housing expense, which I haven't talked about yet. So debt to income is your total debt relative to your total income. Housing expense ratio is your housing expense relative to your total income. So again, easy math to make it easier. Let's say you have total household income of $10,000 a month, and your total debt, including credit cards, student loans, car payments, is $4,300 a month. Let's say the mortgage is $2,500 of that. So your mortgage, your housing expense ratio would be 25% in this case, 2,500 divided by 10,000, and your total debt would be 4,300 divided by 10,000. So those are factors that kind of can go into on a USDA loan. So I will say it is incredibly difficult to get buyers approved under USDA, but if you are the right buyer looking for the right house, it is such a great program. They also must be in a rural area. So in Colorado, the rural areas you're going to be thinking of are like Bennett and Watkins and Wiggins and Fort Lupton, pretty much anything on the east side of Colorado. Sometimes you might get some rural stuff that's in the mountains, and sometimes you might get some rural stuff that's like in some of the towns, like Larimer County has a fair amount of rural stuff. Brighton might have some rural stuff, but that's a lot more difficult, and it definitely needs to be rural, not Brighton proper. And so you can actually Google USDA eligibility to determine whether or not the specific property is eligible, or you can always ask your lender, is this property eligible for USDA? no mortgage insurance is required on USDA. So it's a lot like a VA in that sense, but there is a guarantee fee, which is really similar to that funding fee that's on a VA. So it's a really inexpensive program, which is really nice. The key pieces are going to be getting somebody that has the right credit score, the right debt to income, and makes less than that income. And that's one of the biggest challenges in Colorado, is that those people that make less than that income, their debt to income may be too high for them to be able to qualify for this program. So that's why I see not as many of these as I would like in Colorado. So like I said, it can be a really great program for the right buyer. And borrowers, this is the one program where they don't like assets. So if you make too much if you have too much in assets, it may be harder for you to get approved through USDA. So if you have reserves, you have the money to put down, USDA is going to frown on that. And then your other information, they're really pretty flexible on chapter 13 or chapter 11s and chapter 7s and foreclosures. They only require 3 years. And they have like a really weird rule on the chapter 13s so I just put that in there verbatim. Basically, you at least 12 months worth of payments, and it has to be approved by the bankruptcy courts. So pause and ask questions on USDA. Has anybody done a USDA deal?
I have not for a long time. When I
Yeah.
first got in the business, yes, but I know things change. So curious, especially because Sheila works the Greeley, Evans area.
Yeah.
What do you know about properties out there? Are you finding lots of those
Oh, yeah.
USDA approved?
you can-
I was thinking so too, yes.
Yeah, that's a nice area. If you're not in like Greeley proper, where like Brighton. So if you're in like the city of Brighton, you're going to be not rural. But if you're like on the outskirts, we've got a little bit of land, then you're going to be, that's a good option. I will say that one might be challenging because like, especially when you have any land, then your house is going to be over a certain value. So getting somebody that can buy the house, that makes, a low enough income, doesn't have any assets, that's like a unicorn. So that's why you don't see a lot of USDAs in Colorado. So.
Great.
Okay,
Thank you.
you're welcome. All right, moving on. So I'm going to briefly touch on a couple of down payment assistance programs in Colorado. So we talked about conventional FHA, VA, and USDA. So these down payment assistance programs, they actually are like a layer on top of those other programs. So CHFA is the first one, Colorado Housing and Finance Authority. It's probably the most common. It's probably the one you guys have heard about the most if you've heard of them at all. So again, we love acronyms. So DPA, down payment assistance, bridges the gap between what a borrower has for down payment and what they need. So just to kind of give you guys a sense. So if on an FHA loan, you need 3.5% down, down payment assistance with CHFA will give you a 4% second. And that second is a silent second. And I'll talk about that in a second, but they also have a grant option. So you're basically saying to yourself, okay, well, if they need 3.5% and CHFA gives them 4%, well, great. That means that they can come to the table with nothing. Unfortunately, it doesn't work that way. When you add the closing costs and the costs for a CHFA and for the other programs are more expensive, you do end up needing to bring some money to the table. So in general, I say to most CHFA buyers, if you're looking at trying to get into a CHFA, you should probably expect to spend at least $5,000 for closing costs, up to $10,000, especially if you're doing an FHA. FHA CHFAs are the most expensive to get into, and so that's where you're about $10,000 that you would need for closing. So like I said, they do down payment assistance of up to 4% of the total loan amount. And if they were to do a grant, the grant is fully forgiven. They never have to pay that money back, but that comes with a higher interest rate because no money is free. I will say in most cases when I compare a grant option to a silent second option, especially in Colorado, because our values increase so quickly, most buyers are going to choose a silent second because they know that they're going to be able to pay that back relatively quickly, and they qualify for a lot more because their payment is significantly lower with a second than it is with a grant. But if somebody, if equities don't if they like really, we see them taper off and we're not seeing them increase as much, then we might see grants come back. Or the next program that I'll talk about is another one that's kind of in between those two. So the silent second has no payment and no interest rate. It will need to be paid off if the borrower refinances, if the borrower sells the house, or if they happen to stay in the house after 30 years, they would need to pay that back. They can make payments, but they do not need to. So one thing that I think is helpful for you guys to know from a listing agent side is that if you are working with somebody and they're wanting to sell their house, and you happen to know that they're in a CHFA, maybe they it's the first house that they bought and they got into a CHFA, it's good for you to know that they're going to have to pay off that silent second. So when you're looking at their net proceeds, keep that in mind, because there may be something that's 10 to 15,000 that you don't know about that's looming in the background that's going to also need to be paid off. So they may not net as much as they would expect, because I will say, most borrowers, we tell them and we tell them and we tell them when we get them under contract and they get under there, but they forget that they have that silent second. And so when they go to sell the house, a lot of times, especially if it's been 5 years, they may not remember that that silent second is out there. So again, CHFA is like on top of conventional FHA, VA, and USDA options. I've never seen anybody do a CHFA VA, because why would you? VA requires 0 down. And I've never seen anybody do a USDA option, because again, why would you? It requires 0 down. But FHA and conventional CHFA options are really, really common. There are income restrictions, which are determined based on the loan type, so conventional or FHA, the household size, and the county. And one thing I don't think I have on here, you don't actually have to be a first-time home buyer to qualify for CHFA. You can be somebody that has bought a house previously and just doesn't have that equity anymore, and you can still do a CHFA. You just can't do multiple loans with a CHFA. So if you have an investment property and you don't want to sell that, but you need money for down payment assistance, CHFA is going to be out, but you could always like cash out on that investment property to get the money that you need for the down payment on the second one. So, and then there's a 1% origination fee on a CHFA, which that's one of the things that makes the closing cost so much higher than it does on your traditional conventional, because they're adding that 1% back on there. So again, if FHA requires 3.5 and CHFA gives you 4, well, now your origination fee has made your closing cost more, because that 3.5% plus the 1% origination, now we're 4.5% before we even add any of the other fees associated with the loan. I think, oh, no, one more. And CHFA loans are sold to CHFA, and the borrower will make their payments directly to CHFA. So we basically act as the middleman to help them get into the loan, but they will never be sold to anybody other than CHFA if they're doing a CHFA loan. Questions on CHFA? No? Nico, you've been quiet. Do you have questions?
Nope, so far so good. Thank you.
Okay, cool. All right, so the next one, oh, only the borrower. I knew there was another, I should have known there was another bullet point down there. Only the borrowers can be on the loan. No, only the borrowers on the loan can be untitled. This is a weird CHFA specific thing, that if you have a husband and a wife, and the wife isn't going to be on the loan for some reason, let's say maybe her credit score is bad, or she's self-employed and you don't want to have to deal with that. Only the husband, if he's on the loan, can be on title. They won't allow anybody that's not on the loan to be on title. So keep that in mind when you're writing those contracts. If you're working with your lender and you know that you're putting only the husband on the loan, don't put the wife on the contract, or they're going to make you do an amend.
So
right. Oh,
question though, after closing, let's say they say, oh, but can we just quick claim her on?
So that's such a tough question. And my general answer is yes. Like most lenders are not going to call the note due because you added somebody on, but I will say CHFA is going to be the strictest on that. So my recommendation would be not to do that, especially because because values increase so quickly here in Colorado, most people are going to refinance out of that CHFA or sell that house in 3 to 5 years. In most cases, there's not going to be a circumstance where having that secondary person on title is going to make that big of a difference. But technically you probably could quit claim them on, but it does technically violate the documents that they sign. And CHAFA could technically call that note due if they did that. So I don't usually recommend it. I usually try and figure out a way to get us around that without having to quit claim them on. But yeah, technically, I mean, you could.
Well, my answer as the employing broker would be no, we're not doing that. So talk to your title company. There's some other ways that they could possibly do it with a beneficiary deed, that kind of thing. So that it would look almost as if it's joint tenants or tenants in common. But yeah, right off the bat, I would say no. But
if you can avoid it.
Yeah, exactly.
Don't.
Cool. Thank you.
Thank you for asking that question.
Yeah.
Okay, so Metro DPA is the other program that is in Colorado that is for down payment assistance. You may never even heard of it because it's not a very common one, but it is a good program for the right circumstances. So they actually will provide a silent second up to 6%. So for those buyers that really have literally nothing for down payment, this is sometimes a good option for them. They are, I don't think I'd actually write this in my bullet points, but they're a little bit stricter when it comes to debt to income ratio. So that's a challenge because their interest rate is a fair amount higher than a CHAFA, and they have more restrictive debt to income. So most people, when we're looking at Metro DPA, qualify for a lot less. So I usually, when I'm working with somebody, I'll usually say, can we figure out a way to save a little bit more cash to get you into a CHAFA because you're going to qualify for more. But under the right circumstances, Metro DPA is a good option. So the nice thing about a Metro DPA is their second is actually fully forgiven after 3 years. So it's kind of like a grant with a CHAFA meets a silent second. So as long as they make 3 years worth of payments, that second goes away. It does not loom large over them. They never have to pay it back. And it's actually 1/36 every month that they make payments. So if they were to refinance 2 years in, they only have to pay back that 1 year's left of that second. And so that's kind of nice with the Metro DPA. Their income restrictions are higher than CHAFA. So that's one of the reasons I'll see a lot of people use Metro DPA is because they may make too much money for CHAFA, but not enough money for them to be able to have the savings they need to do no down payment assistance. So that's where that sweet spot is for Metro DPA, because they'll actually use up to 150,000 in qualifying income, which is kind of nice. They're only eligible in certain cities in Colorado. So CHAFA is, no matter where you are in Colorado, you can do a CHAFA loan. But with Metro DPA, it has to be, that city has to have been approved with Metro DPA. And those cities are changing all the time. So I recommend that you talk to your lender to make sure that you're verifying. If you're going to write a contract and you know that they need to go Metro DPA, just make sure that that city is approved. Most of the Denver metro area is in that approval. I want to say like anything like Denver, Lakewood, Aurora, all those. When you get into the north areas where you guys are, Amber and Sheila, those are a little bit harder. Like I want to say Greeley is, but maybe Evans isn't, for example. So just kind of keep that in mind. And conventional and FHA options are available just like CHAFA. So the conventional and FHA are like the base, and then the Metro DPA is kind of the layer on top of that. And they also add a 1% origination fee and additional fees associated with the program to make the costs higher. So the closing costs can be fairly high on those Metro DPAs. Oh, that was the last slide. That was the last one. Okay. Questions on Metro DPA? Nope. All right. Moving right along. All right. So in this crazy market that we're in, I wanted to just take a minute to talk about appraisals and appraisal gaps. I know that it's definitely cooled over the last 3 to 6 months, but I really think it's really good information for real estate agents to have to understand what happens if an appraisal comes in low. So I'm going to just kind of talk through some scenarios on that. So first of all, why is an appraisal required? So we as a lender use the appraisal to determine the value of the property with a third party unbiased source. So obviously the lender has a vested interest in the transaction. If it doesn't close, we don't get paid. Obviously the real estate agent has a vested interest in the transaction. If it doesn't close, you don't get paid. The appraiser has no vested interest in the transaction. So they are that third party unbiased source. So they determine the quality of the property and identify any defects, especially as we talked about with an FHA. And they also mitigate the risk for the lender. So if we know that the value of the property that the listing agent listed the house for and the buyer was willing to buy the property for, that doesn't necessarily mean that it's a worthy risk for the lender. So those are really the main reasons that the appraisal is required. So what happens if the appraisal comes in lower than the sales price? So basically, the lender will determine the loan to value, the LTV, based on the lower of the sales price or the appraised value. So, for example, if the purchase price is $600,000, but the appraisal comes in at 575, we are going to determine our loan to value based on that 575, not the 600 that it's under contract for. So now we as a lender have to figure out what are our options in here, and the buyer and the agents have to figure out what their options are. So in a normal market, you basically have 4 options with when the appraisal comes in low. Option number 1, the sales price can be renegotiated to adjust the sales price down to the appraised value. So 600,000 is under contract, appraisal comes in at 575. The sellers are willing to negotiate down to 575. Lender is, okay, we're good. Now we're going to determine our loan to value off of 575 and everything's all good and gravy. Option number 2, the borrower can choose to bring the additional money to closing. So again, that 575, 600, the buyer can choose to bring that 25,000 to mitigate that issue that there is between the sales price and the appraised value. Option number 3, there can be some middle ground between 1 and 2. So maybe we're under contract for 600, appraisal comes in at 575, we're going to negotiate to 590. So that's a really common one. And then the buyers and the sellers can decide to part ways, obviously. So that's the 4th option. So I want to talk about appraisal gap scenarios because they're so specific to each scenario that I want to make sure you guys kind of understand how it's going to be determined from the lender. So scenario 1, the appraisal is low, but we have a low loan to value, meaning the borrower put a lot of money down. This is the best scenario for an appraisal to come in low. Let's say the contract price is 600,000 and the appraisal comes in at 575, but the borrower is putting $200,000 down, which means that their loan to value is lower than 80%. Okay, I don't even know what that is. It's like 400 divided by less than 70% loan to value. So in this scenario, as long as the borrower accepts that their value is lower, no action is required. The lender is still going to determine the loan to value based on the lower of the 2, but really it has no bearing on our loan because they're putting enough money down. So that's the nice thing. If they're putting a significant amount down, you can bridge an appraisal gap all day long and it doesn't have any bearing on the loan. The one thing I will say is that you may see some changes depending on interest rate, because if your loan to value changes from a 60 to a 70, your pricing, your interest rate pricing may be determined off of that 70 now instead of the 60. So that is one thing. You may have an impact in your rate, but as far as the actual lending is concerned, there's no change. So scenario number 2, the appraisal is low, but we have a high loan to value, meaning the borrower is putting as little down as possible. So in this scenario, let's say contract price is 600, appraised value comes in at 575, borrower is putting down 30%, which is only 5%. So they're maximizing their loan to value. This is where we get into tricky situations. So in this situation, the borrower is likely maxing how much loan they can get. We're probably not in a situation where we can go to the 3% down, but maybe we are. And so in this situation, the borrower actually is going to be required to come to the table with that additional 25,000. So if their closing costs were, or if their down payment was 30,000, now they have to bridge that appraisal gap if we don't negotiate that sales price. So now instead of bringing 30,000, they need to be prepared to bring 55 to 60,000 with their closing costs. So that's scenario number 2. I'm going to pause there because I think that is a really complex situation and I want to make sure nobody has any questions on that. Nico, you unmuted. Do you have questions?
I did unmute. I didn't have questions. I just realized you guys are probably hearing me eat my breakfast. So
Actually, I didn't. Oh, okay.
So Elizabeth,
Yes.
I can just give you some kudos again. I think you're extremely savvy and you know what's going on in this marketplace, because most lenders wouldn't understand that whole, the bridge situation, and would not disclose that or even take the time to explain that to the broker or the borrower, because it is very extremely intricate and difficult to understand and follow. So
It
thank
is.
you so much for that. I appreciate it.
You're very welcome. You're very welcome. Thank you for that. Okay, so scenario number 3 is some middle ground. So scenario number 3, let's say that the appraisal comes in low, but the borrower is putting 20% down. So they're in that sweet spot. And we're assuming in this situation, it's a conventional loan. So in that sweet spot where they don't need mortgage insurance currently. So contract price is 600,000, appraised value comes in at 575. They're putting down $120,000. The appraisal comes in low in this situation, since they're putting 20% down, now our loan to value is not going to be calculated off of 600,000. It's going to be calculated off of 575, which means that now instead of being an 80% loan to value, we're going to be in mortgage insurance world. So I will tell you that in most cases, when a borrower is in this situation, it makes more sense for them to pay mortgage insurance than it does for them to part with that cash. So I'm going to give an example. So I had a borrower that they were putting 10% down. And they got under contract a couple months ago, and they had this crazy appraisal gap that they agreed to pay. And they were putting their 10% down. And the appraisal, of course, came in low because that's what was happening in this market right now. And we had a conversation, and I said to them, okay, you're putting 10% down, which means that we have some wiggle room here. We don't have to necessarily keep you at 10% down. We can bring it up to 5% down. So I said to them, you can, number one, go ahead and bring the extra 20,000 that you were expecting to bring. You can, number two, just go up to that 95% loan to value instead of that 90% loan to value. And that will change your mortgage insurance by $58 a month. Or you can, number three, we can do some variation there where we do what we call a split premium, which means that they were able to pay some additional closing costs to buy that mortgage insurance up front, and then they were able to keep their monthly mortgage payment at the same. Well, these guys were first-time home buyers. They were like, well, we really could use this $20,000 when we get into this house. We're going to choose to pay that extra $58 a month. That's a no-brainer for us because we don't want to part with this $20,000 cash. So those are real scenarios where that actually does make sense, but it's so nuanced to each borrower. And if we're talking FHA, it's a wholly different animal. So these are really just conventional and when you get into mortgage insurance and all that stuff. So those are the 3 scenarios I wanted to run through. Again, I'll pause for any questions. But you guys are so quiet. No questions? Okay.
It's because you're so thorough.
Yes, I am, but thank you. All right, so now I'm going to talk about new construction in metro districts, and Erica knows I'm passionate about metro districts because we live in one, and I don't think enough people understand what they're getting into when they get into a metro district. And we as lenders, as lenders that don't work with new construction, don't always get to explain to the borrower. So I like to make sure that other agents know what they're talking about when they do this. So what do you need to know when somebody is buying a new construction house? For starters, the builder's lender incentives can be very competitive, but it may still be worthwhile for them to shop with another lender. I will say most of the builders, especially in Colorado, we can't touch them with a 10-foot pole as far as their incentives are concerned, just because they keep everything so integrated with themselves, their lender, and it's all such an affiliated agreement that we really usually can't compete with those. But sometimes it makes sense for the borrower to go with a traditional lender than the builder's lender, especially if they have a very complex situation. So the builder's lender may be a really good solution for an in-the-box financing. So you're like a W-2 borrower, you're putting 20% down, everything's all good. Those borrowers, in most cases, me personally, I'm going to recommend they go with the builder's lender because their options are going to be fine and the rates are going to be relatively competitive and the incentives are going to be worth it in most cases. But if you're getting into something where they're like self-employed or they need down payment assistance or they're doing VA or USDA, that's when it makes a lot of sense for them to talk to another lender. Because a lot of times the builders lenders just aren't going to be versed on that. Whereas this is what we do every day. A lot of times builders lenders are like new to the business. They don't necessarily understand everything, or they may not even offer those programs. Like most of them won't offer any kind of CHFA or anything like that. So advise your clients about metro districts, which are very common in Colorado. And I can't remember, I added this slide late and I can't remember exactly what I talked about on this. So I'm going to keep going. So, okay. So metro districts are, if you're not familiar, I'm going to just dumb it down to make sure everybody understands exactly what a metro district is. So metro district is basically when the builder goes to build the infrastructure, they go and they get a bond to borrow that money. So they go to the city or the county or whatever, whoever they get the bond with, and they say, we want to borrow a bunch of money so we can build all the infrastructure, the roads, the parks, the street lamps, all the things that we need to do to build the infrastructure to build the neighborhood. Now that's good because it hopefully makes the cost of the house lower than it would be if they were just rolling that into the cost of the house. But what that means is that metro district, now that bond is in the form of a metro district, which is now charged back to the homeowners that live in that neighborhood in the form of property taxes. Those property taxes in most cases are at least double than what they are if you're looking at an existing home. So for example, if you are buying an existing home and generally speaking, the property taxes in the area are, let's say, $3,000 a year, you can expect a metro district, those property taxes are going to be upwards of $6,000 a year. So the monthly payment on that is going to be significantly higher because now instead of paying $3,000 a year in property taxes, you're paying $6,000 a year in property taxes. And the one thing that I think most buyers don't understand when they get into that is that doesn't go away. That is with you for at least 30 years in most cases, because those bonds are almost always 30-year bonds. And one of the things that Erica and I know from our neighborhood is that the builder doesn't always have the buyers and the homeowners in their best interest. And so they may go get a crazy loan or crazy bond that doesn't necessarily, like they don't care. They're just trying to get the quickest, easiest solution. But when it comes down to it, when you actually get that metro district, maybe you want to reduce your interest rate or whatever. And so a lot of times those metro districts are just really, really expensive. So it's just one good thing for people to know when they get into those metro districts. So with a builder, with a new construction, a lot of times, because those property taxes have not been assessed and because those metro districts are not necessarily farmed up yet, then a lot of times when buyers buy those new construction houses, their escrow accounts are undervalued or underestimated. And so what ends up happening is the builder only collects for a really small percentage of what their property taxes are. And so the buyer goes in thinking their payment's going to be $2,500. And when the property taxes are assessed, and sometimes it can take, a year and a half for those to get assessed, when the property taxes are assessed and they get their new escrow account, oh no, just kidding. Now your payment is $3,000 a month because we didn't collect for enough and you have this huge shortage that you have to make up for. So when you as an agent are working with somebody that's buying a new construction, be an advocate for your buyer to make sure that they understand that what their escrow account should be. And if that's not properly escrowed, help them understand, hey, send some extra money or put some money aside for this because chances are good it's going to come back in the future at some point. And that was it on metro districts and new construction. Do you guys have questions on that? No? Erica, are you going to weigh in on our metro district? Oh, you're muted.
Okay, there we go.
There you go.
Just because we've experienced kind of the hardships, I think, in our neighborhood, specifically, so many people have gone through with realizing what they actually got into 1-2 years down the road. And it's kind of been upsetting to see how many people are impacted this in such a negative way. So knowing it beforehand and looking into it, like to be of service to our clients, like if you're going to spend that extra money in a metro district, maybe you can get this house instead and put your money more into a payment as opposed to paying that tax bill. So I always think about that when looking at those certain areas. So just to try to help them out or see if it's a better fit for them.
Yeah.
So, thank you.
That's good. Thank you. All right, so my last slide is just all my connections. So these links, I have such a stinking common name, Elizabeth Williams. So it was hard for me to like get all my things to be consistent, and some of them are newer than others. So on LinkedIn, I'm Elizabeth little squiggly line Williams. And on Facebook, I'm Elizabeth Williams Loan Officer, but everywhere else, I'm Elizabeth Lenz, Colorado. So if you go into YouTube, I actually have a YouTube channel that I just started, and my Instagram is Elizabeth Lenz, Colorado. And then my phone number and email address are on here too. So if you have any questions, you are welcome to email me. I would be happy to send you the slide deck. I know you guys have been frantically writing notes, but if you want any of those like chapter 13 or foreclosure or any of those things, I'm happy to send those to you too.